So without further ado, I pass the microphone to Tammy. So Tammy, what keeps you awake these days, this night?
Thank you, Dimitri, and good evening, everyone. Thanks for having me speak tonight. Dimitri's absolutely right. There's a lot of things that keep us awake as risk managers. And as you graciously alluded to in the bio, I am head of Counterparty Risk for Wells Fargo, and this is meant to be an interactive panel. In my role at Wells, we're responsible for the management of all counterparty risk that's arising out of traded products, assigning any capital that needs to be held against that portfolio, managing the CCAR stress testing process for the counterparty book, and dealing with the plethora of regulations that have hit our table post-crisis, and making sure that the firm is in compliance with whatever Dodd-Frank regulation related to the counterparty space. And it has been a whirlwind, as I'm sure all of you could attest to, post the crisis. And there has really just been a foundational shift in what we knew to be counterparty risk management pre-crisis and what the counterparty risk landscape looks like post-crisis. And we selected, like Dimitri said, the panel selected some topics that we thought would be interesting to speak to, but I am happy to answer questions during the Q&A section on anything that might be something that you'd want to ask me about in the counterparty risk space, because there really truly has been just a foundational shift in how the regulators are viewing the large banks and what their expectations are of us. The interagency guidance around counterparty risk that was issued recently has really laid out the framework for what the regulators are going to expect in this space going forward. So with that, my topic is the implications of Basel III and for CVA desks, and then the challenges that CVA desks face in light of the stress testing requirements that we have. So the way that I think about CVA pre-Dodd-Frank and post-Dodd-Frank, you have a space where credit needed to be priced. And so pre-crisis, a lot of CVA desks popped up. We were able to measure the credit risk that was in a portfolio on the traded product portfolio, and there had really become a solid mechanism for pricing that credit risk that was held in the book. That credit risk could be marked to market daily, and most firms were able to figure out how to do that, at least within a single asset class, if not across all asset classes. What happened during the crisis is that these CVA books started to post very large losses as spreads widened, and you needed to revalue this CVA book every day, and rebalance your hedges. The losses in the CVA book and being at the former Wachovia prior to Wells Fargo, we really saw a lot of swings in the P&L, both from the CVA and the DVA side, as Wells Fargo's spreads started to, as Wachovia's spreads started to blow out. And I always say the only place that Wachovia was posting a profit during that period was the DVA book. Everything else was kind of going to hell in a handbasket. But what you saw then is when everything was blowing out, there was no capital that was required to be held against those fluctuations in the CVA balance. And so currently Basel II does not require that any additional capital be held against that change in CVA balance. So that was seen as a gap, and it played out in reality. And Basel III is now requiring that capital be held against the potential changes in that CVA balance. And with that comes the requirement that you are able to have a cross-asset, CVA platform across all of your traded products and be able to calculate a VAR on that book and then be able to apply capital either under a standardized or advanced approach. Firms that are approved for what is referred to as IMM, or the internal models method, are able to use the advanced approach. If a firm is not on IMM, then you will defer to the standardized approach. So you see a space where OTC derivatives have really been under a lot of pressure post Dodd-Frank, because in the OTC space, we know that a lot of these transactions are now going to be cleared, and that is changing the dynamic as we measure and monitor counterparty risk. And the posting of the additional margin makes OTC trades more expensive. Having to hold additional capital against the CVA balance is also going to make OTC derivatives more expensive. And as firms are entering Basel III parallel, so most firms are now all in Basel II parallel, as they then migrate to a Basel III parallel state, and I'm speaking primarily in domestic firms, knowing that international firms are further along the Basel spectrum. But as we all enter Basel III, this is just going to be one more pressure point on the OTC derivative space. It's going to make these transactions more expensive to transact, and it'll remain to be seen how firms respond to that and how the market responds to it, and if firms are able to pass on that additional cost to the ultimate end user or the customer. The other space that we see a lot of challenges as it relates to CVA is stress testing. Folks will be familiar with either what is referred to as DFAST, which is the Dodd-Frank Act for stress testing, or it's also been referred to as CCAR. And the annual CCAR process, or the Dodd-Frank Act stress testing, DFAST process, requires that firms stress their counterparty exposures according to some prescribed mandated set of scenarios that the Fed issues to a number, and it's either 18 or 19 bank holding companies, and it's based on the asset size of the bank holding company. That number is going to expand, and I think it's going to expand to, 50 bank holding companies. But be that what it may, Wells has always been in the 18 that have had to do it for the last 3 years. And what is required under CCAR is that you stress your CVA book in a way that would reflect the loss that the gain or the loss, but the scenarios that they give you most likely result in a loss. You stress that book in a way that allows you to report back to the Fed the loss that your book would experience under any of these adverse scenarios. And the Fed then from there is determining whether or not your capital cushion was strong enough to weather the series of adverse scenarios that they give you. The practical difficulties that firms have with this, in theory, what they're asking to do makes sense. Interesting information gets generated as a result of the CCAR process. But the practical implication, and particularly as CCAR expands to smaller bank holding companies, these firms don't have cross-asset CVA desks. And CCAR really requires that you are looking at your counterparty portfolio across all asset classes and taking these hundreds of stressed curves that are across all asset classes, repricing your CVA book in these stressed environments, and not doing it by asset class. The Fed's really looking for you to do it on a portfolio basis. And that really is going to drive some practical challenges in this space for firms that aren't the top tier firms that perhaps already have a cross-asset platform. These second and middle tier firms, it's really going to be an investment. And again, that gets to costs in this space increasing. So if your derivatives book's a certain size, the Fed under the Dodd-Frank Stress Testing Act, it requires you to be able to perform these stress tests. So again, not being able to do that and having to implement these cross-asset CVA desks in order to be able to do that just increases the costs in this space, and you really see the impact of the increased regulatory environment making doing business in this space so much more expensive. So I will stop there and
So let me
ask
just
for any
add
comments.
to Tammy, the point you made on the smaller firms not being prepared to handle cross-asset CVA calculations, and that's very true. And I've been working with numerous firms in this particular space. Let me paint a picture in terms of how a typical mid to low tier bank holding company would look like, right? They have siloed systems, probably limited integration between front office and back office at this point in time. The consolidation of risk happens, the calculation of risk happens individually at different business lines, and consolidation happens, using a lot of assumptions, that they deploy. To be able to move from that particular scenario to a level where you can actually calculate cross-asset CVA is a huge quantum jump for them. But at the same time, these firms are dealing with sizable derivatives portfolio, and they are at a inflection point to decide whether that derivatives book is worth the trouble that they would undergo to be able to manage all these calculations. So that's a clear issue that I see in not so much the top 20 banks, the top 19 banks now got used to some of the CCAR tests over a period of time. They do have robust infrastructure, which I would say is still in progress, but they're getting there in terms of streamlining the CVA stress testing calculations. But certainly the new firms which will get into this particular bracket very soon would, based on what I've seen in the industry, would struggle to comply to some of the stringent Fed requirements going forward. I just wanted to touch on the CCAR test itself, and there's been a lot of commentary around how robust the test itself is, that Fed designed and asked the banks to play. There are a lot of assumptions baked into the test that are questionable, right? So one of the assumptions that I've noted down here is short-term creditors won't start a bank run in the event of the CCAR scenario, right? Which is drop in equity valuations by 50% and then unemployment rising to 12%. So we've been there, 2008. We've seen that banks actually are at risk of being run by hedge funds and some of the clients that they have. So that's a big assumption, but we are including that assumption in the current CCAR test. The other big assumptions that caught my eye is the valuation of some of the troubled assets that still banks carry on their books. There is no way to value them, and accounting for that uncertainty, there is no element being incorporated into the stress test. So that's another piece. I certainly find that while these tests are getting more and more rigorous over a period of time, there are still a lot of assumptions there which, at least to me, leave some of the questions open in terms of how robust the test itself is.
So thank you, Prem. It's a very interesting comment. So maybe then I will ask Doug to tell about his big issue as a trader and head of Counterparty, basically trading, or co-head at Barclays. So
historically, the hedging that has been associated with counterparty risk has been largely associated with the risk itself. That more than likely will be changing over time as people become increasingly focused on the capital implications of counterparty risk and the Basel III charges that go against that risk, which leads a trading desk into an interesting dilemma, is that the hedges that may be most capital efficient for their book may actually not be the ones that are most efficient for their risk, which is where we all kind of live in the shadow of the fact that we have regulators who are telling us how to measure risk in a certain way that may be very different than those who experience risk on a regular basis actually feel about that risk. But traditionally, as much as there can be a tradition in CVA trading, there are the tools that have been available, and largely this all came into being after the CDS market, because before that you really couldn't do much about hedging your credit exposures. But the tools that people used and will continue to use are obviously CDS, market risk hedges, and volatility hedges. One of the things that's different about CVA trading to most other types of trading is that you are always short gamma, and unless you're an option trader with a predilection to selling options, you don't necessarily experience that anywhere else. The reason behind that is that a CVA is a one-sided pricing distribution only when you are owed money, which, if you think about it, comes out to be very similar to what an option looks like. If you look at what the intrinsic value of an option is, it's basically when you are owed money. And so what you're basically trying to do is hedge against the default of a series of options that you've sold to counterparties, which leads to a fairly difficult hedging exercise, especially given that there aren't volatility markets available in many of the products that you would be trading as the underlying risk. The other risk that you have is a correlation risk between credit and whatever the underlying risk is, and somebody's going to talk about wrong-way risk, which is the negative example, the negative side of that problem. But again, there are no tools out there for hedging correlation risk in the markets. It's something that people have tried to develop, but thus far it's been relatively unsuccessful. So in terms of how people are hedging things now, I think it's very similar to what you'll see on most trading desks. As you run a risk report overnight, you get your deltas, you kind of hedge based on how much of the delta you feel like you want to hedge. You measure your volatility, you try to hedge some of the volatility out, although I think volatility in CVA books is probably massively underhedged in general. And then you have to try to deal with the correlation that you have in the book. In some cases, if you feel like you have a positive correlation between your risk and the credit risk that you have and the underlying risk, and you don't have an instrument that you can use to hedge that correlation, what you will try to do is try to get out in front of the risk. So you'll try to get short the credit market, and if you feel like spreads are going to widen, and try to get yourself positioned in the market risk where you're over-hedged so that you can withstand a certain movement in the market without having to re-hedge immediately. And one of the big things that CVA traders have to deal with on a regular basis is figuring out how frequently to re-hedge. Because especially in a situation where you have a cross gamma that's working against you, if you have a very volatile market and you're hedging back and forth all the time, you're basically just losing money repeatedly on the trade. How do you compensate for that? Well, I guess it's you charge your customers for it, because there's really no other place that you can get the money for it. In terms of capital hedging, with the advent of Basel III, there are now two components to the capital. One of them is kind of a jump to default risk, which is the Basel II component. And then we have, as Tammy mentioned, we have a new component that's related to the mark-to-market, which is a VAR measure. Again, that VAR measure has been defined formulaically by the BIS and is not necessarily the way other people would think about their risk. In fact, there was a lot of complaints about that formula when it came out. For some reason that I've never really been able to understand, and I haven't really heard a good explanation for it, you can't use any tranched products for hedging your VAR risk. Perhaps it's because they're not deemed to be sufficiently liquid to hedge daily mark-to-market moves in your position, I'm not really sure. You also can't use proxy credits. So if you want to hedge Caterpillar by shorting Deere, yeah, you're not allowed to do that either. You can use indices, which is bizarre in that you can't use a very similar credit, but you can use an index that may have absolutely nothing to do with the risk that you're actually trying to hedge. And there is a provision in there that you have to demonstrate that you're somehow dealing with the basis, although it doesn't specify exactly what that means, and I assume it's left to the national supervisors. The other thing I would mention about hedging counterparty risk is that as we build up the clearinghouses, there is going to become an extremely large concentrated risk that everybody's going to face to those clearinghouses. At this point, there's no CDS market in the clearinghouse, and if there was, you would clear it through the clearinghouse, and that probably wouldn't work out so well. So it's not really clear exactly how people are going to deal with that risk aside from putting capital against it, because there probably it will be very difficult to hedge. You can probably do bilateral hedges between banks in the future for the purpose of hedging that risk if you choose to. I think just to go back to a couple of things that Tammy said, in particular that the derivatives businesses are going to become much more expensive, and capital is going to be one of the things that's going to drive that, is that because the cost of capital has gone up, and at the same time you have to hold more of it, it's going to become much more expensive to do derivatives. So if you look at a kind of a standalone interest rate swap, like a 5-year interest rate swap, the cost of doing business is going to go up probably somewhere between 8 and 12 basis points on that swap, which people will obviously try to pass on to their customers. There probably are some better solutions that people will find that will take the risk out of the banking system, or at least theoretically out of the banking system, and we've heard that song before, so hopefully this time it actually does go out of the banking system, to other pools of money in the world that can withstand taking that risk and have a lower cost of capital with which to take that risk than the banks will. In general, my personal view is that the capital that people are going to have to put against risk is probably higher than the economic risk that's actually there. And as a result, somebody who's willing to take that risk on an economic capital basis will be a cheaper provider of protection than somebody within the banking system. And therefore, the risk should move out of the banking system. But that remains to be seen. So at this point, we're waiting for the regulations to be completed, and CRD4 has been delayed many, many times. Perhaps it will be completed at some point soon. It's still unclear whether corporate hedging risk, so if you're an oil producer and you hedge your oil risk, if that risk is going to be exempted from the capital rules or not, as it currently is exempted from clearing. And there's been a big push by the banks to get that done. Not clear whether that's going to happen or not. That said, there still will remain a tremendous amount of risk to financial institutions, between financial institutions, and that is currently is a big focus of the banks, is to try to lay off some of that risk. I guess I'll stop there.
Thanks, Doug. Maybe I will add a little bit on Basel III hedging. So one of the things which immediately kind of are noticeable that regulators don't allow market hedges, only credit hedges. So basically, each CVA desk hedges not only credit movement, but also market factor movements, rates, FX, equity, whatnot, cross gammas. So and now all these hedges, they not only not counted toward alleviation of the capital, they actually bring their own capital through their own VAR. So that's a dilemma for desks, what to do with them. Another interesting thing is that if you look at CVA VAR Hedges, as it was already mentioned, you can calculate CVA VaR capital charge using either advanced formula or standardized formula. And if you use advanced formula, then basically optimal hedge is close to how desk hedge CVA delta neutral, like based on spread movements. But if you use standardized formula, it's standardized formula using EAD exposure at default from RWA's definition. So to hedge it basically, or hedge which you apply to kind of minimize this capital charge is closer to jump to default hedge. So there are kind of two different strategies depending which formula you are using. And maybe another comment. Definitely single name hedge, if you have this CDS in the market, is the best hedge against counterparty risk. You can show that it basically minimizes capital the best. The problem is that for some reason liquidity for single name CDSs is diminishing recently, and it becomes really expensive to hedge with single names because of bid offers. So index now becomes, and CCDSs are not traded at all. And as Doug said, there is regulators are not allowed, they don't allow structured trades as hedges. So now it seems like the only possible hedge is with index, which is not quite perfect hedge because of basis between index and single name and all the correlation issues and so on.